Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 10th, 2024. I hope you're doing well. Appreciate you coming by and watching my weekend review podcast. Boy, what a week we had. Lots of volatility, lots of chaos in the market. I'll talk today a little bit about um, what my opinion is on where we're at and the forces driving these moves. But I'll give you a little spoiler alert. I don't think it's over, but I'll make my case. When I say I don't think it's over, um, I do think we are likely going to be headed lower after a slight rally. But I'll make my case later in the podcast regarding the charts and the technicals and the Japanese yen and the VIX and so forth and so on. So did a lot of studying last night. I wanted to have a good presentation for you. So hope it's going to be helpful, and I hope everything in this podcast is going to be helpful. And if it is, I would appreciate if you could subscribe, hit the thumbs up button. Really helps out the channel. So the format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I currently have. We're going to talk about when I entered them, why I entered them, what the setup was, what the signals were, where my stops are, how I'm going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading simply is the ability to create a good trading plan, a good trading process that incorporates position sizing, good risk to reward ratios, and then a plan of what to do regardless of what the market does. We have obviously no control over the market. We have to have control over ourselves and to execute on our plan, whether it goes our way or goes against us. That's really what it takes, and that's really the best that you can get. So, and all that comes down to your mind. Is your ego going to get in the way? Are you going to follow what you set out? Probably what you set out initially is probably good and decent, but when the lights start flashing and things start going and your emotions get revved up, sometimes we can override what our plan was. But almost certainly, even the the worst plan is probably decent as long as you follow it. I mean, and that's why I have the podcast here. Hopefully to help you, give you some ideas on how to develop a good plan for yourself. So we'll talk about trader psychology. After that, I have gone down through my watch list, both on the daily time frame and the weekly time frame, and I have identified some potential trades that I'm interested in potentially entering next week if they do what I want them to do. There are certain levels that I have identified that if they reject those levels, then I will potentially take a trade. All right, so I have them both on the daily and the weekly. They're not where they need to be yet. One of the best things in trading I've learned in my 29 years is identify that level, wait for it to get to that level, and then think about taking the trade. Because if you're not in the trade and you just look at a chart and go, if it gets down to there, that would be pretty good, usually works pretty well. Doesn't mean the trade's going to be always going to be profitable, but if you wait for it to come to a good location, then you're probably going to have a better chance. It's like baseball. If you could just stand at the plate and wait for a perfect pitch to come, your hitting percentage would be a lot better. But unfortunately, in baseball, you only get 3 strikes and then you're out. But there is no 3 strikes rule in the market. I think Warren Buffett said this. So you can wait there and wait for a perfect pitch. Even if you have a perfect pitch, it doesn't mean you're going to hit the ball, though, right? But it's going to improve your chances. So anyway, hope you like my baseball analogy. But that's what we're going to do. I have identified some on the daily and also on the weekly. Let's get started. Let's get this U.S. legal disclaimer out of the way, and I'll be right back in about 40 seconds. Thanks a lot.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with my current trades, and here we go. This is GLD. I did enter GLD on the 29th of July at 219.26. Why? Well, notice the bar here in the highlighted box, the green highlighted box. You can see the previous day before that we gapped down strongly. So for whatever reason, there was a lot of negative sentiment overnight, gap down. However, the very next day we gapped up. So we went from everything being very bearish to boom, bullish. You can see how this bar is kind of hanging by itself. Gap down, gap up. This is what's called a bullish abandoned baby. They call it an abandoned baby because it's just kind of by itself here. But I really love bullish abandoned babies island reversals, and if you'd like to learn more about it, on my YouTube channel I have a video about why they're one of my most favorite new strategies. And when you have a gap down and you have a gap up and then you look off into the future, many times, more times than not, when this pattern happens, you're going to be higher in the future. It doesn't mean you're always going to be higher in the future. Now, when you have this gap down and gap up, the top of this abandoned baby tends to be a very strong support level. So I didn't go long on gold the very next day. I waited to see if it would come back and test the top of this abandoned baby, which is exactly what it did. And I got a good entry there at 219.26. Now, on abandoned babies and the island reversals, my exit, my profit, and my loss are pretty simple. What I do is I place a 2 ATR emergency stop below, and I place a 4 ATR profit target above. So it's a good asymmetrical risk. If I'm right, I'm going to make twice as much money as if I lose. And that's what you want to do in trading. You want to have, if you're right, you want to make more than if you're wrong. Okay, so in my experience, these abandoned babies and island reversals tend to hit my 4 ATR profit target about 70% of the time, and about 30% of the time they hit my 2 ATR. But it's fine. If 70% of the time I'm making twice as much as what I'm losing 30% of the time, you can see over time that's really going to be profitable. So pretty simple. Take the trade, 2 ATR loss, 4 ATR gain, and so far you can see on the 2nd of August, I thought, oh my gosh, I'm going to get to that 4 ATR pretty quick, but it didn't. It sold back, or it sold off, pulled back. But this particular trade doing well so far, up 2.33%. So that is a bullish abandoned baby. Secondly, the Qs. I am long the Qs, and like I said, after we go through the potential setups that I have for next week, I will talk specifically about the Qs as far as what I think is happening here. But I did get long the Qs on the big down day at the close of the market at 435.60. Why? Multiple reasons, confluence of reasons. The more entry signals you have, the more likely your trade's going to work. So the first one was that this is a deep dip buy. Okay, this is a deep dip buy approach. We went under the 30 RSI and closed above it. That's one. That's legitimate by itself, but it's better to have multiple. Also, we rejected the 200-day moving average, the black line. During the day, we went under, closed back over. And then on top of that, you can see this line here. This is a long-term trend line that we broke below and then closed back above. So I did get long here at 435.60. I placed my emergency stop 2 ATRs below. So if it gets there at any time, I'm completely out of the trade. Only about 5% of the time will it get there, but it does get there. I have one to show you that proves that it does get there today on NVIDIA. But that's my 2 ATR. So if it gets there, I know exactly how much I'm going to lose. But again, only 5% of the time, in my experience, that happens. End of day stop is a close below this 200-day moving average, this black line. Now, I have an orange line up here. This is my trailing stop level. If I take a trade and it gets to my trailing stop level, then a lot of the pressure is off, because now in the future, if it reaches there, and now in the future, if I get a close below a previous bar's low, I exit half of the trade, okay? Because if it keeps going up, I'm not going to do that. But if I get a close below previous bar's low, I'm going to get out of half of the trade. So the emergency stop, the end of day stop, the going into trailing stop level, these are all defensive moves, which means that if it goes against me, I'm going to do something. But I also use offensive moves, and the offensive moves is that I take partial profits if and when the price moves the value of 0.45 ATR. Right now, the 0.45 ATR is 532 from the previous bar's close. So right now, we're at 450.41. I would take 450.41, add 532 to it. That would be my first profit target for Monday. Then I take my first profit target, add it again, that would be my second, take my second, add it again, that would be my third. So I always have 3 standing limit orders in for the next day based upon what I just showed you here. And I always take off 10% of however many shares I have remaining going into the day at those levels. Sometimes I'll hit 1, sometimes I'll hit 2, sometimes I will hit 3. Unlikely to hit 3, but it happens. I think I've hit 6 or 7 before. Or it goes down and I hit none, right? But that's the offensive part, is taking partial profits when the market gives them to me. Not all, but partial. So the day that I bought here at 435.60, the next day it moved up. I took a little off. I think I hit 1 profit target, maybe 2. I can't remember now. So what does that do? That locks in some profits, that reduces my overall position size, which is good. And then the next day we went down hard again. Thursday we went up very large. I hit 2 profit target there for sure. And so again, I keep reducing my position size, locking in those profits. And then Friday it went up, but not enough for a profit target. So I am in trailing stop mode right now. You can see on Friday we got into trailing stop mode, which I'm glad. So again, Monday or anytime next week, if we get the first close below a previous bar's low, that's kind of a bad sign. And so I will take off half of whatever remaining shares that I have. But again, the entrance was a very nice confluence. That's why I took the trade under 30, over 30, under the 200, over the 200, under the long-term trend line, close above. And so the remaining shares that I have on Qs up 2.75%. So pretty good. UNG. Okay, UNG is natural gas. We already talked about abandoned babies. Here we go. You can see the green bar, or the green box. Previous day we gapped down, followed by an immediate gap up, right? So very bearish to very bullish very quickly. In addition to that, take a look at the red MACD bars here. Here we have a low, deep red MACD bars. Okay, now we are here at the low here. We're lower here than we are over here, but look, the red bar's not very deep. So this is what's called a double bottom with a bullish divergence. It just means from a MACD perspective that although this move down looked very strong, from a MACD perspective, it was not as strong as this move. And so the implication is that you're running out of sellers, and the implication of that is that if you run out of sellers, you're going to go up. So big picture, I had this double bottom bullish divergence, and we had the abandoned baby. So it gapped up, we gapped down, we gapped up. Remember, the top of the abandoned baby usually will hold support. When it got down to it, it's exactly where I bought at 1309. And with this particular strategy, it's the simple one. I have 2 ATR stop below me. I have 4 ATR profit target above me. So I just set it and forget it. It's either going to hit my I'm going to lose 2 ATRs if I'm wrong. I'm going to make 4 ATRs if I'm right. And so far, and I don't scale out on these particular trades. It's just one and done. So this particular trade doing nicely, up 8.33% on this bullish abandoned baby. Okay, Microsoft. Microsoft is a trade that I took on Friday. And why did I take the trade? Well, black line here is the 200-day moving average. Okay, the previous bar we closed below it, and now on Friday we closed above it. So now that 200-day moving average is going to be my line in the sand. It's going to be my end of day stop. So I entered at 406.02, which is exactly where it is now. So completely break even on the trade. I set my 2 ATR emergency stop below. If it gets there, I'm out, right? No matter when. Early morning, midday, afternoon, it doesn't matter. But only about 5% of the time is this going to happen. The other 95% of the time, if I have a losing trade, it's just going to be a close below this 200-day moving average. Even 1 penny, I will get out. Up here is the orange line. What's that? That's my trailing stop level. So if it gets there, then I go into trailing stop mode. So this is a brand new trade that I took on Friday. We'll see. I don't know, but it is a good risk to reward ratio, right? We're just barely above the 200, and so if it closes below the 200, I'll simply get out. I can always get back in if it closes back above the 200, or if it goes lower, maybe gets to the 250-day moving average or the 30 RSI, or both of them together. So this trade completely even. Okay, so those are the open trades. Gold up 2.33%, Qs up 2.75%, UNG up 8.33%, and Microsoft totally even. Let's go to the closed trades. So here is, this was a nice trade on TLT. This is bonds. I got long bonds back here on the 25th of July. Why? Well, the main reason is that we closed under the 200-day moving average and closed above the 200-day moving average. This is the black line. I got long at 92.27. And when I got long, of course, I placed my 2 ATR emergency stop below. Just like on Microsoft, my end of day stop is just a close below the 200-day moving average. Trailing stop level 1.5 above. But there's one additional thing about this trade that I like, and I talked, many weeks ago I talked about this when I was looking at the potential trades for the next week. A little hard to see here, but you see the 200-day moving average. This is the black line, but you see the gray line. See how we went? The gray line was under the 200, then it closed back above. This is called the golden cross. What I have noticed in all my years of trading is that if the 50 goes above the 200-day moving average, or in other words, it creates a golden cross, the first pullback to the 200-day moving average usually tends to be a good entry. So the under 200, over 200, just by itself is legitimate entry, but the entry is improved by the fact that the golden cross happened. And, just like I said, it doesn't always happen, but I did say, ooh, I like this because the 50 is closing over the 200. Therefore, if I get a legitimate signal at the 200, it probably will improve the trade. And it certainly did. So 92.27. Next day we gapped up, took some profits. Next day we gapped up, took some profits. Next day we gapped up, took some profits. So I'm continually reducing my position size. Up again, more profits, more profits, more profits, more profits. Unbelievable. And then I did exit the trade here on the 6th of August because it had all the signals to get out of the trade. We had a close below a previous bar's low. We rejected the 70 RSI. We closed below the 5 EMA. These are all rules for the deep these are all rules for all of my trading strategies once you get up into these levels. And by the way, if you would like to learn about how I trade, I do offer private one-on-one lessons in the evening time via Skype. I have taught people from all over the world. It's a 15-hour course. I teach you all of the setups, all of the strategies that I use. We go through many, 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 many trades over and over and over. So I know for sure that you know that what all the rules are. But if you're interested, my email is in the link of the description. I'd love to work with you. It's an investment. It's $1,750, but I promise when you're done, you will know some really good trading strategies. And like I said, I've taught people from beginners to hedge fund managers, and you're going to learn a really good skill. So if you're interested, just send me an email. Love to work with you. But on this day here on the 6th, again, all the exit strategies told me to get out of the trade, and I did. And the uh, the remaining shares I had here up 4.45%. So really good trade. But remember, the 50 crossing over the 200 and the pullback to the 200, because when I go through the potential trades that I have for next week, I have one of those at least as well. So TLT down up 4.45%. Okay, NVIDIA, worst trade that I've had. I did hit my emergency stop, got caught up in that big sell-off on Monday. So why did I take the trade? Well, this is a long-term trend line here, very long-term trend line here. On the 30th of July, we bounced right at it, came up, pulled down. The day that I bought it because intraday we rejected the long-term trend line. I got in at 107.10. I placed my emergency stop 2 ATRs below. My end of bar stop would simply be a close below the long-term trend line. And the next day, boom, look at this. My emergency stop was at 93.30, but it actually gapped below. And that can happen. It definitely can happen. And it did happen to me that day. So I was out right at the bottom. It's too bad, right? Rallied pretty nicely off of that, but I have to follow my signals. I have to follow my signals, and so I had to get out for a 14.08% loss. Now, does this mean that I lost 14.08% of my capital? No, because if you position correctly, getting to your emergency stop, regardless of what percentage it is below your entry, if you position size correctly, you're going to lose 1% of your total capital. Now, this did open a little bit below my emergency stop because it was such a big day. So I lost a little bit more, like 1.1% or something like that. But it's a good example. You never know what's going to happen, with what happened with the currency, with Japanese yen and all the drama. You have to have, and had I not done it, would I have been in better shape? Sure, I would have, but it could be down here. So you have to follow your rules. So on the closed positions, TLT was a gain of 4.45%. And again, on NVIDIA, the loss was 14.08%. Kind of a bummer, but that is what happens sometimes, and that is trading. Okay, let's do a little bit on trading psychology. This is a great channel, Trading Composure over on X at Trading Composure. Puts out really, really good posts. When I see one of these posts, I always read it because it's always valuable to me. And he's absolutely right in this post. If you run out of capital, it's game over. Don't run out of capital. All in is what mindless gamblers do. Be different. Focus on survival. So listen, he's right. If you go all in on a trade and lose, you're done. Your trading career is over. That is why it's very important that you learn to position size correctly. Personally, what I do is I take 1% of my total capital, like I did on the NVIDIA trade. I divide that by the value of whatever the 2 ATR is. Let's just say, I have $100,000. 1% of that is $1,000. I take $1,000, divide it by the value of the 2 ATR. place my emergency stop 2 ATRs below. Therefore, if it gets down to my emergency stop, I lose 1%. But again, that only happens 5% of the time. But you can see it did happen on NVIDIA. But the point here is, if you position size correctly and you have a huge loss, it doesn't hugely affect your trading account. But if I had gone all in on NVIDIA and that had happened, then it'd be a whole different story. You're never going to be able to become a better trader if you don't have experience. And if you run out of money, you're not going to get the experience. Does that make sense? It's like, I want to be a really good baseball player, but I broke my bat, therefore I'm never really going to be a good hitter if I have a broken bat, right? So in my honest opinion in trading, the most important part about trading is not the setups, it's not your stops, it's your position size. It is your position size. So it's important that you position size based upon the volatility of the market. Right now, the volatility of the market is much higher than it was a month ago. Therefore, you should buy fewer shares. And by taking 1% of the capital, dividing it by the 2 ATR, the 2 ATR accounts for the volatility, and a position sizes me absolutely perfect for what's going on. So if you run out of capital, it's game over. Don't run out of capital. All in is what mindless gamblers do. Be different. Focus on survival, and it's really true. And this comes down to position sizing. And if you run out of money, you're out of the game. If you're out of the game, you won't improve your trading. So capital preservation is the most important part, everyone. It really is. Okay, let's head over and talk about the potential trades that I have for next week. Now, excuse me, I have a little cough today. Here I have 10 symbols for next week. Now, it is possible that all 10 of these could trigger on the same day. Does that mean I would take every trade? No. If all 10 of these triggered on Monday, I would only pick one. I would pick the best one out of all 10 that triggered. What would make me pick one over the other 10? Whichever one has the highest quality score. How do you figure quality score? How many entry signals were there? How many confluence of signals were there? How did it look on multiple time frames? What was the market relative? The particular market that I took, was it stronger or weaker than the relative market? These are all things that I factor into making my decision. It's like a report card. Maybe they all trigger, but Apple, for whatever reason, has the highest score, had the most signals, had the best risk to reward, it had the best relative strength, it looked best on multiple time signals. This is what's important. The devil's in the details. This is what I use to narrow down to what is the best trade of the day. And again, this is what I teach my students in my 15-hour one-on-one course. And if you, like I said, if you work with me, absolutely, I will teach you all of these. So here we go. Apple. Now, Apple had the huge sell-off. I couldn't believe my eyes in the morning when I saw, I think it was down 22 points or something. Unbelievable. But yes, we've had this really nice little rally here, but I honestly don't think it's going to last. Honestly, you can see this red box here. What is this red box? This red box is an order block. This is a bearish order block. This is the highest up bar close before market structure change. And when you break structure to the downside, very often you will have a knee-jerk reaction back up. But if you get back into this order block, very often this is where it will fail. In addition to that, you can see this was a long-term trend line that we broke. Now that we've broke the trend line, we have two major levels of resistance above us. One level of resistance is the trend line. This used to be support. Now it is above us as resistance. In addition to that, you see how the trend line dovetails right in the bearish order block? Yeah. So if during the week, I 2 or 3 times a week, I put out some day trades that I have. And if you've watched those, you've seen this exact setup work over and over and over, where you have a structure break, you have a bearish order block, you have a trend line, If you get back up to that trend line in that order block, very often it will head back down. And that's what I think is going to happen for the entire market, to be honest with you. So what am I going to look for to enter this trade? So multiple things could happen. One option is that next week, if we head up and we reject the bottom of this red box, or in other words, we reject the bottom of the order block, that might be enough to get me in. If we don't reject the order block and we go higher and we reject the trend line, that would also be an option. If we don't reject the trend line and keep going up and we reject the top of the order block, then that would also potentially get me in. And then my stop would just be a close above this swing high here. So I am definitely looking for some kind of short position on Apple next week. If we continue up, I'm not sure that we will, but if we do, rejection of the bottom of the order block, rejection of the trend line, or rejection of the top of the order block, I would get short. Okay. Adobe's very similar. Long-term trend line, we broke that to the downside. Now it's above us as resistance, just like Apple. We have a bearish order block here in the red box. This was the highest up bar close before the structure break. Now with this one, a couple options too. One, if we reject the bottom of the order block, I would consider getting short there. Although the 200 would make a lot of sense because one, it's the 200-day moving average. Next week, if we rejected that 200-day moving average, I could potentially get short there as well. And the nice thing about that is it gives me a very close risk to reward. So next week, if it rejects the 200 and closes below, then simply if it closes back above the 200, I'm simply out. So that's what I like about having that 200 in there. A week ago or so, I closed out that huge trade, short trade that I had on natural gas. And it was almost exactly similar. Rejection of the 200-day moving average in a bearish order block after breaking the long-term trend line and getting a structure break to the downside. I'm not saying that's going to happen on Adobe, but that's what I'm looking for. So rejection of the bottom of the order block, potential rejection of the 200-day moving average, potential rejection of the trend line that's above us as resistance, or rejection of the top of the order block. So wish I could be more specific. I just have to wait and see. But basically in this area, in this red area is most likely where it's going to fail. Amazon, AMZN. Okay, so Amazon, we did go under 30 over 30. We rejected the 300-day moving average. Also rejected the 250-day moving average, have not been able to break above the 200-day moving average. I'm not interested in buying Amazon if it closes over the 200. I'm really not. What I'm interested in on Amazon to get long, first would be a pullback and rejection of the 250-day moving average. That would be one potential scenario. Ideally, to me, coming back and testing this 300 would probably be a better entry because one, it's lower, and two, if we get back down to this 300-day moving average, you'll probably be closer to the 30 RSI. One of the best setups that you can get on a big major stock like an Amazon or a Facebook or an Apple or whatever is a confluence of a rejection of a long-term moving average and a rejection of the 30 RSI at the same time. So for me on Amazon, remember, waiting for that pitch, right? Waiting for that really good pitch across the plate. I don't have to take this trade. I can say, okay, the ideal setup on this would be a rejection of the 300 and a rejection of the 30 RSI. Sounds good to me. I mean, those are good setups. They don't always work, but they work more often than they don't. So that's what I'm saying here. I mean, I'm open to the idea that if it comes down and rejects the 250, potentially take that, maybe throw in a V1 or a V2, something like that. But honestly, when I first looked at this, my first gut thought was a rejection of the 300-day moving average and a rejection of the 30 RSI would probably make the most sense. So that's what I'm looking for on a long on Amazon. And I don't care if it closes over 200. I'm not going to buy it. Berkshire Hathaway. Okay, very similar to Apple and Adobe. Looking for a short. This one's pretty easy to see. We have the order block, the highest up bar close before market structure change. If it gets back to there, that's going to be a shortable area. You can see the trend line. We certainly broke the trend line as well. So what I'm looking for on Berkshire Hathaway is a short if next week we go up and reject the order block, the bottom of the order block, 439.64. So if we get there, close back below, then I potentially take that trade. My close would just be, or my stop would be a close over the top of the order block at, looks like 443.88, something like that. So we'll see. We shall see. But I'm not going to mess with it unless it rejects the bottom of the order block, maybe does a bearish V1 or a V2 in the bearish order block, or rejects the top of the order block. So looking for a short on BRKB, which is Berkshire. FedEx. All right. Well, again. Oh, this is what I was. Oh, no. No, it's not. Different stock. Different stock. Okay. What makes sense to me? It's the 200-day moving average. Is it going to get there? I have no idea. If it gets there, I will certainly consider taking that trade. 100%. But I don't know if it doesn't get there, I'm just not going to mess with the trade. See how easy that is? I look at the chart. Oh, if it gets the 200, look, it's the 200, 250 here as well. That would make a lot of sense. I mean, look, last time it was the 200. Was that a decent place to buy? It certainly was. Sometimes these things have memories. So if you're looking at buying at the 200, look back in the past. Did it respect the 200 back there? It certainly did. Does it mean it's going to respect it this time? No. But is it more likely that it's going to respect it now? If it respected it in the past, yes. So again, no one's forcing me to buy FedEx, and I'm not going to buy FedEx unless it gets to where I want. And where I want is the 200-day moving average. That also dovetails with the -6 ATR channel. So this looks like a pretty good place, if and only if it gets there. I don't know. Seems like a long way away. May not get there. Probably won't get there. But if it does, then I may take a shot at it. Goldman Sachs, GS. Okay, well, same thing. We had a huge break of structure. We broke the long-term trend line. Where would I be interested in? Do I want to get long this stock? Absolutely not. We had a massive, massive structure break. Yes, it's rallied nicely, but I am looking for a short. I'm looking for a short at the bottom of this order block, about 504.54. So if we go up to it, reject it, potentially get short here, my stop would be, I guess, all-time highs there. The second option is if we reject the bottom of the trend line. That trend line was support. Now it's resistance. So first option, rejection of the bottom of the order block. Second option, rejection of the trend line. Third option, rejection of the top of the order block would be the shortable areas. Pfizer, PFE. Okay. What was the trade that I showed you? Oh, it was gold. Yeah, it was gold. And I was talking about the golden cross. I was talking about the 50 crossing over the 200. That happened back here in July. See how the gray line crossed over the 200? So again, if you have a golden cross, the first pullback to the 200-day moving average usually is a really good bounce area, just like GLD. So Pfizer, we've had the golden cross. But are we back to the 200 yet? No. It's kind of like FedEx. Will it get there? I don't know. Probably not, right? Chances are it probably won't go down that far. But if it does go down that far, that is a really good potential opportunity. Doesn't mean it's going to work out, but it's a good potential opportunity. So what's that? 27.49. We're at 28.55. Oh yeah, it could get there. You know, it seemed like a lot further away down, but yeah, it's not that. It's $1 away. You know, a little more than $1 away. So I like this trade very, very much. Is it going to get there? I have no idea. But if it does get there, I will certainly consider it. So we had the golden cross. After you have the golden cross, the first pullback to the 200-day moving average generally is a good signal, um, high probability signal, just like it was on the GLD trade that I showed you. So I'll just hang out and wait. If it gets there and rejects it, I'll definitely consider taking it. The SPY. Okay. So I have all this stuff up here to show you after we go through these potential trades for next week. What I like on the SPY for a potential buy, I wouldn't be buying the SPY right now, but you see the line here. This is a long-term, very long-term trend line. We lost it. We went above it. We lost it. Now we're above it. Very often when you break a trend line to the upside, very often you will come back and test that trend line before having a larger move up. And so that's what I'm looking for. Sometime next week, I'm looking for a retest of this trend line. Right now, the I mean, if it's hard to say, but if we move like on Monday, the trend line be about 522.60. I mean, it changes every day, but you can see the trend line, right? So it depends if and when it gets there. But if we do come back, retest that trend line, get a higher low test of that trend line, I would definitely consider it. But right now, it's in the 522, 523 area. So, it's about 10 points below. And I would be I wouldn't be surprised at all if we came back, but we held it. I'm looking for a retest of the trend line. My stop, if it rejects it, my stop would just be a close below the trend line, similar to NVIDIA. Okay, VIX. Well, VIX's volatility, you can see what a huge move up. Now, I've talked about all these stocks that have broken market structure to the downside: Apple, Berkshire, Goldman. I am looking at those to rally a little bit more and then to fail because they're getting into the bearish order blocks. Well, this green area here on VIX is most likely a bounce area. We certainly broke structure to the upside, right? So here we have a bullish fair value gap. This little guy here would be your bullish order block because it's on the downside here. So that would, oh, I guess I'll leave that blue. Yeah. So I don't think VIX is done. Yes, huge move up, all sorts of stuff happened, but we are coming back into some bullish areas for VIX. And if VIX gets bullish and goes back up, what do you think the market's going to do? And so this dovetails a little bit with what I'm going to tell you about the market and when we're done with this. But I expect VIX to come down a little bit more and bounce in this green or blue area. And therefore, I'm expecting the market to go a little bit higher and then fail, right? That's why I'm looking at all these shorts on Apple and Amazon and Goldman Sachs, but I need them to go a little bit higher. And if they do go a little bit higher, I think they'll fail. And VIX is confirming my thesis here structurally because we certainly broke market structure to the upside. Now we're obviously pulling back very strongly as the market goes up, but the VIX is getting into some areas where I would buy it. And if I would buy the VIX, I think the VIX is going to go up, and therefore I think the market's going to go down. So it's kind of tough here on where I would buy VIX here. I don't think I would buy VIX with the rejection at the top of this order block because of this fair value gap, because the range to my stop is just too far down. So what I'm looking at is the 100-day moving average here, the red line. It's nice. It's about halfway into the bullish fair value gap. It it's an area that had support of the previous resistance. This was resistance and we broke out of it. Now that's going to be support. But the main reason I'm looking for that 100-day moving average, the red line at about 49.77, so close to $50, is it would give me a good risk to reward. If it rejects the 100 and closes back above, I would probably take that trade. But if it closes below the 100, then I have a good risk to reward ratio. Does that make sense? So, roughly call it $50, which would make sense because we got up to 91, right? So, um, that's what I'm looking for right here and right now is a rejection of that 100-day moving average. That would probably get me long VIX. And if VIX bounces there, that will probably be the top of the market. But does that make sense how VIX is coming into a buyable area where the market, if it goes up, if it comes down, it's getting into a buyable area, whereas the market, if it goes up a little bit more, getting into a shortable area. And then last but not least is Walgreens. So Walgreens, the one thing that really sticks out here to me on Walgreens is this very, very definitive double bottom bullish divergence. Look at the lows over here. You see how deep the red bars are? So this means there's a lot of selling momentum. Now look over here. We are just as low here as we were over here. But look, no red bars whatsoever. This is called the double bottom with the bullish divergence and a missing right shoulder. This means we're essentially running out of sellers. And again, if you run out of sellers, what's most likely to happen? You're most likely to go up, right? If you run out of sellers. So I still need to, so the big picture here, the layout, the lay of the land, I like double bottom, bullish divergence, ATR divergences, RSI divergences, all sorts of divergences going on with WBA. But I still need a signal. And my signal at this moment would be a deep dip buy with an under 30 over 30. Right now we're at 33.74. So next week, if we go under 30 and over 30, that would be a legitimate entry signal, especially big picture that you have this huge double bottom bullish divergence. But you have to place my stop, right? I have to place my 2 ATR emergency stop below because Walgreens is really out of favor. It could go down. I guess it could go out of business, right? So I have to place my stops in that emergency stop for sure. But this is getting very close to an extremely legitimate signal. Double bottom, bullish divergence, missing right shoulder. I just need that trigger to get me into the trade and then give me a structure to trade this around. Okay, and if it went under 30 and over 30, then what's my stop? Well, 2 stops. 1, 2 ATR emergency stop below. Second, if it just closed under the 30 RSI, I would simply be out of the trade. But anyway, those are the trades on the daily. Let's head to the weeklies. And like I said, when we're done with the weeklies, I'm going to do a little analysis on the S&P and the NASDAQ as well. So stick around for that. Okay, advanced micro devices. These are weekly bars. Look, this 200-day makes a lot of sense. A lot of sense, or 200-week, excuse me. 200-week moving average, the black line makes a lot of sense. It's dovetailing with the negative third ATR channel. 92% of prices when they get to the negative third ATR channel tend to hold, stop going down, or go up. That dovetails nicely with the 200-week moving average. So again, it's one of those trades where if next Friday we go down and we reject the 200-week moving average, I'll probably take the trade. Doesn't mean it's going to work, but what it means is it gives me a good risk to reward ratio. If it closes below the 200, I'm simply out of the trade, right? If below the 200, I'm out. Above the 200, I'm in, and then I'll scale and do all the stuff that I do, right? But the main thing here is that 108.48. If it gets there and rejects it, would make a lot of sense. All right. Walt Disney. Okay. So this is a little more complicated. Not really complicated, but a little bit more complicated. So here we're to 30.52. Okay. So technically on Friday, this was a legitimate signal because it went under 30 closed over 30. But take a look at this green line. This is really what I'm keying off of. This green line, what is this green line? Well, let me take you to the monthly chart. Whoa, the monthly chart. Look at the 200 monthly chart. Did it respect the 200 last time? It certainly did. Look at this little under 200, over 200. You would have bought it $80. At some point, it got to 126. That is a key level. That 200-day move or 200-month moving average is a key level that it respected last time. So now the 200-month moving average is 82.93. That's why I drew the line at 82.93. Okay, so back to the weekly. I know on the higher time frame that 82.93 is a key level on the monthly. That's the 200 on the monthly. So what I'm going to wait for next week is if Disney goes down, rejects 82.93, then that's a decent level because that's the 200-month moving average. So essentially what I'm looking for on Disney is a rejection of 82.93. That's it on the weekly. And if it rejects it, closes above, I'll position size to place my 2 ATR emergency stop below. And if it then on a weekly basis closes below that, then I'm simply out of the trade. So again, a little bit more advanced trade because I'm using the monthly 200 as the key level to trade on the weekly. But again, Disney by itself did trigger a legitimate deep dip buy last week because it went under 30 and closed over 30. But I'm just going to wait for a little bit more confirmation. And that 82.93 level is important. That is a major level on the monthly, the 200. So really that's what I'm looking for. Rejection of 82.93 by next Friday. If it is, then I know what my level is. A close then in the future below 82.93. I'm just out of the trade. Okay, so that's Walt Disney. And then Rio Tinto. Okay, well this one's pretty simple. Nice upward sloping 200-week moving average. If we come down, what's that at? 60.60. Right now it's at 63.24. Doesn't mean it's going to get there, but if it does get there, I like upward sloping. I guess it's kind of leveling off, but in general, kind of upward sloping. So, rejection of the 200-week moving average would make sense. Just gives me a good structure. If it's above the 200, I'm in. If it's below, I'm out. That's it. And then you have to, have the discipline to stay in above too. But that's what I'm looking for, rejection of the 200-week moving average on Rio on the weekly. Okay, let's again talk about the major indexes. Let's start with the Qs. Okay, so I am long the Qs, as I mentioned, but we are really there's a lot of heaviness above us on this chart. I'm not saying it can't just go up. Heck, it could go back up all-time highs. I don't know. But from a technical standpoint, we have a lot of key areas that are above us. This is the bearish order block, the red box. This is the highest up bar close before market structure change. You're going to have a very difficult time getting in here. What's the blue box? The blue box are bearish fair value gaps. Now, we are running into all of these. We're in a bearish fair value gap right now. Let me point your, oh, shoot. Let's see. Guess I'll move that down there. I'm going to make this red. Okay. What is this red line here? There's a lot of resistance at this red line, 450, 440. It's about $4 above. Why? See the bottom here? This is called the breaker. We broke back below it. If we get back to that, that is going to be resistance. So yes, we could rally a little bit more, but we are going to have some issues here at about 450, 440. And even if we go higher from there, now we're inside this huge down bar. So I guess what I'm saying here, everyone, is I am not expecting this rally to to have a lot of legs. We had a huge move down. I think this is a little bit of a dead cat bounce. Sentiment's changed to a little bit more positive, but at the moment, the huge down move we had changed psychology. It changed the mindset of a lot of traders. Now they are a little worried. So again, we're in a bearish fair value gap. We have a bearish order block above us. We're coming into a breaker. So I'm just saying be very careful. In my gut, yes, we may go a little bit higher, but then I think we're going to come back down. And that's what looking at the VIX chart told me as well. And that's why I'm looking for the shorts on Apple and Berkshire and Goldman Sachs, because they're all coming into bearish areas as well. Now, I don't know. The Fed may come in and do something. I don't know. I could be wrong. It just could head back up. But this is very heavy. We may have another week up, possibly. But I think that's going to be about it, because especially if this line here at 465.40, this is a major area of resistance, because we have this big down bar here, and halfway that big down bar is going to be a huge amount of resistance. And people that took these losses, and then if it moves up, they'll be very happy to mitigate their losses. So 465.40, that's what I would say about as high as any rally could take us. 454.40 on the Qs is going to be some issue here as well. So very likely, I think we're going to continue to rally a little bit and then pull back. So I'm just saying, be careful. I think we're going to do a retest based upon these technicals. And then let's look at the SPY. SPY, of course, is very, very similar. Um, it's funny. You see this box here, this tan box here. So I consult with a hedge fund on a monthly basis. And when we had our call, I was telling him that this red area in here was very likely to be a lot of resistance and head back down, especially with the trend line here. You see, we broke the trend line, then we came back to the trend line, and then we failed. And so I put this little tan box in here, and I said, this is the most likely area to fail. Holy smokes, was I right on that one. Oof. Anyway, on the SPY, we are coming into some major resistance here at 537.10. It's about 5 points above us on the SPY. Why? The thick red line here, the bottom of that bar is the breaker. That is going to act as some resistance. We also have these trend lines above us that once were support, now they're resistance above us. So again, maybe we rally another week. It wouldn't surprise me. It wouldn't surprise me. But I think I feel very strongly that any rally is going to fail. I really do. So anyway, I hope that was helpful. So listen, if you'd like to learn more about my trading, a few times a week I do put out a video on YouTube where I talk about some day trades that I have using a lot of these same signals. So check that out. They're about 10 minutes, 12 minutes. I think you'll find those helpful. Um, Also, again, I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course, 5 sessions. Each session is 3 hours. Cost is $1,750. But the best way to learn anything is with one-on-one with your instructor. At least that's my opinion. In that course, I teach you all of the different setups that we have. We go through, we do repetition, repetition, simulation, simulation. And when you're done with that course, you're going to be a much better trader. All you have to do, send me an email. Usually after I get the email, we set up a free Skype call. We just introduce each other, ask you about your trading goals, your challenges, what you hope to achieve. It's a good time for you to ask me any questions about the format of the course. And then when we're done with that call, that's it. It's up to you. If after the call you liked what you heard, just email me, call me back, and we'll start the lesson. But it's such a good course, and it really is such a great course. So just email me and we can get the conversation started. Also, I have a great online video course available at udemy.com. The link is in the description. In that course, I teach you the deep dip buy stock trading strategy. It's very affordable. It's between $30 and $50 depending on the day on Udemy. Has 4.9 stars. And in that course, I teach you the deep dip buy stock trading strategy step by step by step. It's a great course. I've sold so many around the world. So anyway, and then I also have free lessons on my YouTube channel as well. So I hope today was helpful. If it was helpful, I would appreciate if you could hit the thumbs up button. If you have any comments or questions, leave them in the comment section. I'll do my best to get back to you. But I always leave off with, please try to go out and do something nice for someone today. If we all did one nice thing for another human being, it really would make the world a better place. If you could do something nice for an animal, that would be great. I'd appreciate that. Animals appreciate act of kindness just like we do. So have a great rest of your weekend, everyone. Please be careful for next week. Again, my bias is that we rally a little bit more and then we go back down again. But I don't know if I'm right or not. That's just my bias. Time will tell. So hopefully see you next week. God willing, we'll see you next week. And have a great rest of your weekend. Thanks, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.